Welcome to MizoChoice, your channel for financial planning, investing, wealth building, business ideas, career guidance, and smart money tips. Watch this video to learn, grow, and achieve financial freedom. Please like, share, subscribe, and leave your valuable feedback. Thank you for being part of the MizoChoice family.
Guys, we're going on here about mutual funds and stocks market and related to that future that and things you and I should know before investing in mutual funds and stocks that uh, most of people start at investing because that they hear gossip or stories that people are talking about that by investing in these mutual funds and stocks markets, so it's an easy and simple way to become rich. That's way they invest it, and others want some people recommended them to invest in this, and others invest cause fear of missing out. Anyway, investing without knowledge, without sound knowledge in financial or any commerce background or any accounting knowledge or any business knowledge, especially financial knowledge, so can lead to losses and frustration and a lot of despair and disappointment. So before investing even single rupee, before you spend or you expense even a single rupee, so do sound knowledge, do have sound knowledge or research or consult financial consultant like me, so you can consult me related to the financial planning, wealth creation, wealth building, wealth management, and any types of investments. What we are right now we telling about that. So let's take a look about this expense ratio. Expense ratio. So before investing in mutual funds, you have to do some research. Expense ratio. Expense ratio simply implies that annual fee that's charged by the fund and some, let's say, 0.56% is per flexicap fund, okay, and 0.2 is exists mid-cap fund. So which one you gonna choose? So you gonna choose this one cause it's lesser. So the lesser is the better in case of expense ratio. Okay. So let's take some example in case of expense ratio. For instance, you invest at 1 lakh. Okay, 1 lakh, 1 lakh. We invest this. We invest 1 lakh, and let's do this 1%. How 1% annual expense ratio? 1% annual, okay? Annual expense ratio affects that 1 lakh investment. So here, as we already talked about that investment is 1 lakh and expense ratio is 1%, and so annual cost is 1k. If you calculate that expense ratio is 1% and investment is 1 lakh rupees, then annual cost is 1k, and remaining value remaining value is 99k. It's simply okay. For you all understand, I just take a simple case for you all to understand, to get knowledge, some knowledge about like a basic knowledge. Okay, this is remember that before market gains or market losses. So things you should remember is lower ratio means more money stays in your pocket. Lower expense ratio means more money stays in your pocket. Okay, it's very easy and simple. And so before you invest in any types of mutual fund, whether it's large scale or medium scale, small scale, or anything, or whether it's flexi cap or value best value advantage fund or aggressive or equity or debt. So you have to do research. The first thing is expense ratio. Then the next one is AUM, assets under management. And assets under management tell us how much money investors have entrusted to the fund. Okay, how much money investors have entrusted to the fund, and bigger is not always better. It's not always better, but it's popular and it's uh, quite okay, but it's not always. It's not focal point. Okay, let me write here like in a short form. This is small fund. Okay, small fund, small fund. Let's say 100 crore, and medium fund 5k. Medium fund is 5k crore, and large fund large fund is okay. Let's say 50k crore. I can show you in chart or graph too, but we don't have much time. So before investing in mutual funds, so you have to take a look at expense ratio and assets under management. That's total money managed by fund. So the larger or the bigger is you have to uh, keep it as uh, a good thing to choose that, and it's popular. Okay, like it say, higher assets under management means more trusted and popular cause lots of investors and lots of small investors, so institutions or like big organizations. Here we have past returns. I don't think we need to define this from the word itself. It says that the past returns, previous performance funds in 2001, it performs quite good. In 2002, not bad. In 2003, great. But the fact is that don't take only 1 year or two. Consistency is very important. Maybe in 2001, the record is very good. It's high. But the next year slows down, and the next year again much lower it can be. So At the same time, you have to take a look at the past returns, but don't depend fully or completely on that past returns. Okay. So before we move forward, regarding the past returns, you have to check that. Let's say that in 2021, in 2021, it's around its core rate is around 7%. Let's say in 22, 15%, and 23, 10%, 24, 25%, and in 25, 12%. It's growth pattern. So the golden rule for viewers here, check that expense ratio first. And the next thing you have to check is that fund manager, fund manager, fund manager. Investing in mutual fund is very easy and simple, and it's really not complex. So there are fund managers which was appointed, and fund manager performance is very important. uh, Take a look at the fund manager performance and their experience and all about their backgrounds. Okay, and check that assets under management. Check at least 5 to 10 year performance. Check at least 5 to 10 year performance. Not a single year or two. Check at least 5 to 10 year performance. How consistent, the good pattern, and everything else that, and the risk level. The risk level. If you want the high return, then risk level is high. Especially in case of equity, risk level is high, and in case of debt, the risk level is moderate or low, and the return is low. Right? So let's move on. Portfolio holdings and risk level and volatility, exit load, and SIP suitability. So we have to understand that actual difference between saving and investment. Saving simply implies that keeping your money or keeping saving your money for your short-term basic needs or necessary needs or whatever your needs. Just keeping your money or saving your money for short-term needs, and investing implies that uh, putting your money into assets that can grow over time, like buying a machinery or buying, uh, for instance, you buy like a vehicle, like truck or whatever, SK or a larger one. So that is your asset, cause that vehicle earns you more income through that asset, through that machinery. Okay, So investing means that you converted your money into assets by using your cash. You bought an asset that lets you earn cash money over time. Saving basically protects your money. Okay, it's right. It's all right. It's just protects your money, but investing helps your money grow faster than inflation. Inflation is that you have to remember, you have to take care of inflation while investing. Both are quite important for everyone, but saving just protects your money, but investing helps you earn more and more income by buying an asset or by buying machinery or by buying a vehicle that lets you earn another income or more income, keeping in mind inflation too, right? So you just cannot ignore, but you just cannot ignore both savings and investment. But investment is better. Saving just protects or just keep your money for your basic needs or for short-term needs. But investment lets you earn more and more income through your earning. You purchase another assets and that assets let you earn another income. So it's really fast, go fast, faster than inflation. Let's say that inflation rate is 9% and you invest in mutual funds and let's say ROE, return on equity. That's how much money you invested. You invested. From that investment, you earn income. So return on equity, return on your investment, a portion is like 12. So inflation doesn't affect much, but just savings your money, you earn rupees 50K per month, and you just save it 50K per month. After 5 or 10 years, after 5, 10 years, it's the same money you have. But here comes time value of money. What you could purchase at the time of invest at the time of your investment, let's say in 1995. In 50K, you could purchase that, okay, machine, any machine, any types of machine, okay, let's write machine. So in 1995, you just can buy that, but in 2026, it's costs the same machine costs 2 lakhs. So saving is not odd or it's not feasible. But if you invest in mutual funds, the interest is it's compounded. Okay, it's compounded quarterly or semi-annually or annually. So grow that percentage 12%, let's say. And as time passes, your money also grows. So inflation doesn't affect and your value of money won't bother you if you invest in mutual funds, though the risk is still exists. Your portfolio holdings is that stocks or assets that the fund invest in. That you invest stocks or assets that the fund that you invest in. In case of portfolio holdings, that it's a diversified equity mutual fund, diversified equity mutual fund, and it's an example of like illustrative allocation of a mutual fund portfolio. Uh, let's say here, not here, we don't have much. This is X, okay, and Y and Z. X implies that you invest in cash or no, I mean that cash and others, and Y is large cap stocks, okay, large cap stocks, and Z is mid cap stocks, and here are small cap stocks, okay, small cap stocks. So actually, portfolio holdings show where your money is invested, where your money is invested. Maybe you invested in large cap stocks or middle cap stocks or medium cap stocks or small cap or maybe another like flexi cap or hybrid. There are lots. Okay, so portfolio holding simply implies that where you invested, where you invested. Well diversified portfolio review says that risks compared to that putting all your money into a single company. Suppose you Reliance, it's very popular. You invest rupees 2 lakhs and you put here in Reliance Industry. You invested in Reliance Industry all your money, rupees 2 lakhs, and another person invested rupees 2 lakhs in Reliance, Hindustan, Zinc, ONGC, Coal India, Asian Paints. So this means diversified, not investing in a single one, investing in uh, various stocks is much better, and it's reduce risks comparing to investing in a single one. Okay, so things I'm sorry that so things you should remember that investing regarding that portfolio holdings is that where your cash or your money is invested, and whether you invest in a well diversified stocks or in a single stocks. So investing in a well diversified means, like we have said, that in various stocks, like at least 5 to 10, 5 to 10 stocks is cool enough. But don't invest or don't put all your money into one stocks, okay? Single stocks. In case of mutual funds, uh, your portfolio, like your holdings, at least five. Suppose you invest in parak flex cap, and second one you invest in mid cap fund, exists mid cap fund, and third one small cap fund, like UTA or your no UTI or SBI, and fourth Nifty Index 50 fund. Uh, invest in direct growth. Direct growth is best, okay? And fifth, like SBI equity hybrid funds, hybrid funds. So five is enough for your portfolio holdings, okay? So we move to the risk level or volatility. How much fund price moves up or down? So things regarding this you have to remember is higher return potential usually means higher risks. High return equal to high risks, and low return equal to low risks. High return is equity and low return is debt. Here we have like risk levels of mutual funds. I can show you like in graph or charts to risk level. Let me show you. The first one is liquid fund. Okay, let me write in short form. Liquid fund. Your the risk level is very low, and debt fund. Debt fund. And here the risk level is slightly higher, and hybrid fund it's more higher, and large cap fund and small cap fund small cap fund. Here the risk level is lowest. Liquid fund only this much, and in case of debt fund much bigger, and in case of hybrid fund bigger, and large cap fund this much, and small cap fund. So I hope that you grasp some knowledge to this. And volatility implies that how much the value uh, moves up and down, like moves up and down. Okay, volatility. And small cap fund can deliver higher returns, but they can also fall sharply during market corrections. You small cap fund, the risk is high, and the returns too high, and especially can fall sharply during market corrections. And here, for an easy rule, okay, low risk. Let me write in short form. Low risk equal to debt or liquid funds. Debt or liquid fund is low risk, and medium risk is, as we have already all taught, hybrid funds. And high risk, high risk is and equity and small cap funds. Okay, so I hope that you understand about the risk level and volatility. That volatility, that's the markets are moves ups and downs, and how the risk level using that parameter and using that I just described. I tried my level best so you understand that. And here, exit load. Exit load simply implies that penalty fee for withdrawing early. So I don't think it's necessary to explain for more details. So exit load is that the penalty fee, how much that's the fee is that it's different regarding that how much you invest or like how much you withdraw, okay, related to that. So the penalty fee you pay for withdrawing before the maturity period, okay, the maturity period. And exit law discourage short-term investing, and you have to check always that how long you need to stay invested to uh, paying this charge, and before you invest that you are going to invest for long term like 10 to 15 years, or you are going to invest for short times uh, less than 3 years. So make sure or make uh, an absolute decision before you invest in any types of mutual funds or in any types of stocks. Whether you are looking to invest for a long term, 10 to 15, or maybe less than 3 years. Less than 3 years is a short term, and 10 to 15 year plus is a long term. Okay. And things you should remember is that lower exit load simply implies that it's better flexibility, right? And long-term investors usually don't worry much about exit loads. Short-term investors worry about that exit load. For long-term investors, like I've said, that more than between 10 to 15 years, or maybe more than that, 15 years. So no need to worry for long-term investors so about exit load, and it doesn't affect much about their investment, right? So things you have to keep in mind here that before investing, make a clean and genuine decision and a sharp decision that whether you're going to invest for long term or you're going to invest for a short term. And the next one is SIP, systematic investment planning, suitability, best for investing small amounts regularly, or you can invest in a lump sum. Lump sum is, for instance, you're going to invest rupees 5 lakhs. So you invest for lump sum means just pay at once. No need to pay another month or quarterly basis or semi-annually. In case of SIP, you can invest daily basis or monthly, weekly, quarterly, semi-annually, the same amount, or you can upgrade that. Okay. And SIP, regarding SIP, regarding SIP, regarding SIP, that SIP allows you to invest a fixed amount every month. Like in Feb, you invest 5K. In March, you invest another 5K. In April, you invest another 5K. Yeah, it goes on like that. Or you can upgrade that in uh, at the month of March, you invest 5K, and in April, you upgrade to that 6K, 7K, 8K, or whatever. You can start SIP from very small amount like 100 rupees in Indian INR. And some funds require minimum investment 500, and some 1K, some 5K. It's different. Okay. So you have to checklist, just checklist for that regarding SIP investment. One is that long-term goals, like I've said, that 5 years plus. Okay, let's say that less than 3 years is short term, and second one is your income must be regular, so that you can invest regularly every month. If you don't have regular income, then investing regularly is completely or absolutely impossible. And comfortable with market fluctuation, market market ups and downs, market fluctuation. And your mindset should be wealth creation. Wealth creation, or maybe called wealth building. Okay. So I hope that that's uh, cool enough for you to understand and grasp knowledge, especially those who do not have any sound knowledge regarding financial well building or investment or management or business. We can move on. You're creating an emergency fund. Creating an emergency fund, and before investing, before you invest in stocks or mutual fund, build an emergency fund. Okay. Lump sum suitability. Lump sum suitability. Lump sum is pay at once. And benchmark comparison, Nifty, Sensex, and Alpha Beta. Uh, we're going to explain this step by step. And here The first and the foremost thing is create an emergency fund first. It doesn't matter that how much you earn, how much you uh, income per month or per daily basis, whether you are layman or you are laborer or you are government servant or you are working in a private company or big corporations like MNCs or foreign companies or whatever you are doing or working or you are holding any jobs and before you invest in stocks or mutual funds, just keep that an emergency fund. Okay, and it should be at least 6 months of living expenses in a savings account or liquid fund. Like we've already mentioned, that liquid fund, that fund, it's lower risks in savings account. Interest rate in savings accounts interest rate in is about 2.7, 3.5. I'm, I'm not really sure that it's based on simple SIP, simple interest. It's not compounded too. Okay, but if you do deposit like fixed deposit or recurring deposit or multi option deposit, it's around 6 to 7%, and it's compounded. It's calculated based on compound interest. Compound interest is golden rule, golden innovation, golden discovery. Okay, so create an emergency fund first for investing before you invest in any types of mutual funds or stocks, and like uh, just you can calculate by yourself that like 6 months, maybe much more than that or maybe less than that, 6 months of living expenses that you used to spend, that you used to expense, maybe like electricity bill or basic needs like necessary needs. So it helps you from selling investments during emergency. This is very, very important. It's really important. You don't need to sell your your investment during emergencies too. If you keep savings enough to protect you at the time of emergencies. Okay, so lump sum suitability best when investing big amount at once. Like I've already mentioned, that's investing amount at once. And lump sum suitability here, let's take a simple case like rupees 1 lakh, and you invest this money as a lump sum. That means you pay that rupees lakh all at once. Okay, I can show you some example of how a one-time like lump sum investment may grow over time, but uh, it gonna take times. A lump sum investment uh, in is simply implies investing a large amount at one time. You invest a large amount at one time, and it's okay, it's suitable when markets are reasonable value. Then you have a long investment horizon for long long term investment horizon. It's suitable for long time horizon, and your checklist. Please make sure that before you go to lump sum, make sure that you have large amount or it's available at your hand or at your account or wherever. Large amount is available, and your investment horizon is at least 5+ years. Large sum available, and your plan of investment is to be at least 5+years. Like investment is, and the market sometimes goes up and sometimes goes down, up, down, up, down. So that short-term market fluctuations or short-term market declines won't bother you. So you can handle that short-term market fluctuations or market slowdown or market declines. You must be handle that to do or to invest in lump sum base, right? This checklist is very important for starters or for be a sole proprietor or business owners, or whether you are an individual investor or institution based or organization based. Especially for individual investor, it's really important. Okay, and benchmark comparison. Benchmark comparison is compare fund with market index. Comparing fund with market index like Nifty, Sensex. As we know that Nifty 50, like the biggest or largest uh, companies, and Nifty Next 50 and Sensex too. I think I don't need to explain Nifty and Sensex. It's really popular, and so he thinks we should take care of that benchmark comparison that is the fund beating the market. For instance, compare a mutual fund with its benchmark index. Okay, you have to compare. You have to compare that mutual fund with its benchmark index and fund versus fund and benchmark comparison of annual returns. To I can show you with graph or charts, but it will take a long time. And a benchmark is the fund's report card. Benchmark. Benchmark equal to funds report card. Like if a fund consistently beats its benchmark over many years, it suggests the fund manager is adding value, right? And an easy rule that here, let me make some easy rule for your checklist for your remember. Let's say that here fund and here benchmark. Comparing fund, uh, comparing that fund is less than the benchmark, then it shows that it's positive signs. Positive sign, okay? And in case of opposite fund, and benchmark. Uh, so, for instance, fund is higher than no, I mean, fund is less than benchmark for let's say for many years. So you have to review carefully. Okay, you have to review carefully when the benchmark is greater than fund, and when the benchmark is less than fund, then it's positive sign, right? I think you understand benchmark comparison. Like I've said that compare fund with market index like Nifty and Sensex. Nifty and Sensex is we all know that. And the next one is alpha. Alpha, alpha. I hear that it said that extra return above benchmark, extra return above benchmark, and higher is higher positive is better. Okay, so it's very easy and it's really simple that alpha is that extra return above benchmark. Benchmark, we already know that what actually is benchmark and what it implies benchmark. So extra return above benchmark and higher positive is better, and it measures that extra return generated by fund manager. Fund manager. Fund manager tool already explained and mentioned that. So extra return generated by the fund manager, and we have formula too, but it's not necessary for you for the starters. So for instance, let's say that here fund return equal to 15% and expected return is 12%. So alpha is positive 3%. So the gap is that here 12 plus 3 is 15. Fund return 15% and expected return is 12% and alpha is 3 plus 3. So alpha measures extra return generated by the fund manager, right? And positive alpha means that the fund manager generated returns above expectations. Expected return here we already mentioned here. So positive alpha is fund manager generated returns above expectations. Higher positive alpha is generally better. Okay, I hope we all understand clearly. There's no hard or there's no difficult things regarding that. So here the last point we're going to discuss here is beta. Beta measures how much a fund moves compared to the market. How much a fund move compared to the market. And the formula is fund volatility divided by market volatility, and visual comparison to and illustrative comparison of sensitivity to market movements like low volatility fund and market average and high VF. Beta tells you how aggressively a fund reacts to market movements. Regarding the market movements, how fund reacts. Here, fund, and here, market movements. So it's related. Okay, fund and market movement is go side by side, and it does affects each other. And interpretation here, let's say here interpretation here, let me write beta 1.0 simply implies that it's move roughly like the market, and it move roughly like the market, and here beta greater than 1, more volatile than the market. Okay, here upper one here, it's move roughly like the market, it move roughly like the market. Okay, it goes side by the market, and here more volatile than the market here when beta greater than 1. When beta equal to 1 means it move like the market, and when beta greater than 1, then it's more volatile than the market. I hope everything is clear regarding beta. And in case of beta, that it measures market risks, and 1 is equal to market level risks. One is market level risks, and it measures market risks. So I hope that we can move that where to next as comparison level. I've shown in the graph chart too. I show you all things that's important, and I've got some complaints or explanation regarding that. Too slow. Some says that you are too fast, and some says that they are too slow. So I don't know which one is normal. So I tried my level best. All I want is that for all of you to grasp all that I have said, and to acquire all knowledge that I already explained to you. So let's move here. Clear high interest debt. Clear high interest debt. If you have credit card debt or high interest loans, clear them first. It's an easy and simple rule, and there is little benefit in earning 12% from investment while paying 24% interest on debt. It's really an it's really very simple. So there's nothing to explain regarding this. It's basic rule for investment or for saving in case of savings and investment. So it's very rule that all your debt or all your loans you have to clear first, and you have and your earning level that and from your investment that's earning levels while paying your debt. That's the word percentage makes a huge plus. Okay. Sharpe ratio, return compared to risks taken. Return compared to risks taken, higher is better. So no need to explain. If you take the high risk, then the return is high. If you take low risk, then the return is low. So it's nature truth in case of investment regarding mutual funds, related to mutual funds and stocks. And here, return on equity. So regarding here, Sharpe ratio, it's really simple and it's there's nothing difficult to understand. So I guess and hope that no need to explain. There's nothing to no need any explanation regarding this. But I just want you to let you know that higher survey ratio means that the fund is delivering better returns for the amount of risks taken. Okay, higher survey ratio. So the fund you invest that is uh, delivering better returns for the amount of risks you've taken. So, for instance, let's say that below one, in case of Sharpe ratio, below one is average. Below one is average, okay, and around one is good, then above one is great, okay. So, in the simplest rule, that is comparison of that risk adjusted performance and return minus risk free return and divided by volatility. So Sharpe ratio tells you that how much return you are getting for the risks you are taking. For instance, you are investing in mutual funds. Let's say exists mid cap fund, and you have done enough research before you invest that, and the past performance and the fund managers and number of holders, small investors and all, and expense ratio, everything, Sharpe ratio, and exit load, everything regarding that. So you've done enough research and you took an a risk and you invested rupees 1 lakh per month. Let's say SIP or lump sum, pay at once. So expected return, expected return that you expect that return percentage is 12%. In actual return, you got 14%. So that's extra return, okay? No, you, uh, whatever and how much you invested, whatever you invested in investment, risk is necessary and risk is unavoidable circumstances. Without risk, you cannot invest. When the risk is high, the returns is high. So whatever risk you are taking and the returns that you get is Sharpe ratio. Okay. So next one is return on equity. Profit making efficiency of companies in portfolio. Return on equity is return on equity. Here let's me write. Return on equity is from that amount or from that money you invested that the return you got is that maybe it's 14% or maybe 32% or 77%. So return on equity is mainly used to evaluate individual companies held by the mutual fund, and it measures how efficiently a company uses shareholders' money to generate profits. And return on equity equal to that net profit divided by here net profit divided by that shareholders' equity into 100. With this, you can calculate that. For example, net profit is rupees 20 crore. Okay, let me write here. Net profit is 20 crore and shareholders' equity is 100 crore. So return on equity is here 80. No, 100 and net, net profit is 20 crore. Okay, and shareholders' equity is 100 crore. So return equity is 20%. 20%. It should be 20%. And it measures that how efficiently a company uses shareholders' money to generate profit. We are here. Turnover ratio. Turnover ratio implies how frequently fund buys or sells stocks. Lower, often better for long term. From the sentence itself, from the word itself, that we are it's easy to grasp or it's easy to understand, and it's comparison of trading activity. We can compare like fund A, fund B, fund C, and their trading activity like 0%, 60%, and 120% like that. Okay, so it's very simple case that 20% is very low trading and 60% is moderate trading and 120% is very active trading. So a high turnover ratio means that, let me write here, high turnover ratio. High turnover ratio means the fund manager frequently changes holdings. High turnover. Fund manager manage that whatever you have invested in uh, any types of mutual funds. In mutual funds, there are fund managers. Uh, you just cannot choose them, so it's appointed by itself. So higher high turnover ratio implies that fund manager frequently changes holdings, your portfolios. Okay, this can increase transaction costs and may affect that tax efficiency. So high turnover ratio affects that transaction costs and tax. And high turnover ratio that implies that fund manager uh, frequently changes that your investment, your portfolio, your holdings. Okay, it's really simple. There's nothing difficult, and fund house reputation. So no need to discuss this. I hope that it trustworthiness and track record of that AMC asset management company. So it's fund house reputation, whether it's the fund house is reputation is uh, quite noticeable or it's ours. You have to do research before invest, right? Your future. Everything depends on our future. We are looking for our future, and everything depends on our future. We are investing for our future, and we are saving for our future. We are living for our future. We don't know that in our future what's gonna come, and in our future what will happen. But this time, today, or is what you can do for yourself, for your family, or for your children, or for your grandchildren. Price to earning ratio, stock price compared to company profit, stock price compared to company profit. Okay, stock price compared to company profit. Lower mean cheaper. It's very easy to understand. So you have to know your financial goals, as I already mentioned and earlier, that whether you're gonna invest for long term or short term, or how much you're gonna invest, and whether you have regular source of income, or at what age you gonna retire, or regarding your children's educations, or like real estate, you're gonna buy a house or you're gonna sell, or regarding that financial freedom, and your goal determines where and how you should invest. And the most important things is that why you're gonna invest. You're gonna invest for your retirement after you cross 60 plus, or you're gonna invest for your children's education, or for buying house, or for buying luxury cars, luxury vehicles, or for uh, freedom from financial problems or financial struggles, or everything depends on that. So your goal and your thinking, or your goal determines where you should invest and how you should invest, how much you should invest, and whether uh, You should invest in stocks or mutual funds or cryptocurrency or gold, digital gold or government security or RBI backup bonds, everything related with that. Okay, so price to earning ratio, as mentioned, that it's really easy price stock price compared to company profit, and lower means cheaper. And price to earning ratio tells you that how much investors are willing to pay for a company's earnings, and it's market price per share divided by earnings per share. Let's take a small example here. For instance, let me write in short form, not to take much time. Let's check share price. Okay, share price rupees 500, and here earnings per share is 25 rupees, earnings per share. And here price to earnings ratio, how much would be price to earning ratio? Price to earning ratio would be 500 divided by 25, 5, 20. It's very simple. So I hope that you grab some knowledge regarding that. It's really simple, that nothing to nothing difficult, or nothing difficult to understand, or nothing difficult to grasp. I hope we can move to the next level. ROCE, return on capital employed. Return on capital employed. Return on capital employed simply implies that how efficiently company uses money to earn profit. Higher is better. It's a very simple explanation here. So you regarding we have talked earlier that you have to know that your financial goals, and you have to ask yourself and why you are investing, and why you are investing for retirement, children education, buying a house, real estate, or get rid of financial struggles or financial problems. So that before doing that, so you have to research by yourself, or consult a consultant, a financial consultant, or wealth management, or mentor, or guidance, or investment consultant. Like me, you can always consult me through my WhatsApp or my mail, which I put in my description or link. Okay, always can talk face to face, or can do that video call, or we can do I use contact that Zoom meeting too, and mentor many people too, and do subscribe my channel, or if you are not yet subscribed, and you will find many useful video relating to investment, and like how to earn from online, and like you are an aspirant for competitive examinations, so it's the best for you. Okay, so return on capital employed, and how efficiently company uses money, how efficiently company uses money to earn profit. Higher is the better, it's natural truth. Lower is odds, right? and return on capital employed equal to EBIT divided by capital employed into 100. So it's really very easy, and there are visual comparison regarding that comparison of the capital efficiency that company use, like company A, company B, company C. Like I can show you that comparison too, but it's going to take times. That return on capital employed shows how effectively management uses both debt and equity to generate profits, especially long term. Okay, I hope that we can move on the next one. OPM. OPM is operating profit margin. Operating profit margin, operating profit margin, and OPM, operating profit margin, profit from business operations, and higher equal to stronger business. Okay, and OPM measures how much operating profit a company earns from every rupees 100 of sales. So formula is OPM equal to operating profit divided by revenue into 100. And for instance, I'm going to show you that. Let's take a look here regarding OPM. uh, I'm going to show you that regarding that OPM. Yeah, I'm going to show you regarding OPM, operating profit margin, and revenue. Here, let's take a look here. Revenue equal to let's say that rupees 100 crore. Okay, rupees 100 crore, and operating profit equal to rupees 25 crore. Okay, right? Then operating profit margin is 25%. It's very easy. There's no complex things. There's no need to hassles or difficult or no struggles. So things you should keep in mind that a higher operating profit margin means that the company keeps more profit from its sales after covering operating expenses. Right? After covering operating expenses. Operating expenses. And the next one is promoter holding. So promoter holdings and all is that's a though you have to research by yourself. It's very easy to grasp and easy to understand, so I don't think it's no need to necessary to explain. And percentage that shares owned by founders or promoters and higher usually gives confidence. And number of shareholdings uh, gives that are higher usually give confidence. So we can move on to the next level. I think it's very easy and simple, and explanation too. We can move here. So dividend yield and debt to equity ratio. So understand risks and return. Risks and return. As we have already explained, that higher risks equal to higher return, and lower risk equal to lower return, and higher return usually comes with higher risks. And no investment can guarantee very high returns without risks. So it's natural truth regarding investment in mutual funds and stocks. And so if someone promises huge returns with zero risks, don't fall on that prey. Okay. So debt to equity ratio, dividend yield is dividend that you earn from that you invest. So here, in case of regarding dividend yield, we call that X debt, that the debt that you receive dividend. So before the X date or on or before the X date, on or before you receive dividend, or on or before the X date, you must reinvest that dividend you receive. Okay, so debt to equity ratio. Company debt compared to own money, lower usually safer. It's very easy and simple and no need to explain much. And debt to equity ratio, in case of that debt to equity ratio here, for you all to understand that total debt total debt is we divided by shareholders shareholders equity. Okay, shareholders equity total debt. So let me show you, for instance, regarding the debt to equity ratio here. Let's say I'm going to write in short form. Total debt is 50 crore. Okay, rupees 50 crore, and shareholders equity is 100 crore rupees, 100 crore. And here debt debt to equity ratio is 0.5. As I've mentioned here, total debt divided by shareholders equity. Okay, this means that the company has rupees 0.50 of debt for every rupees 1 of shareholders equity. And there are visual comparisons that we can I can show you that comparison of financial leverage among companies like company A, company B, company C, but this one takes a long time, so I'll not show that. I've already gave some examples for you all to understand, so I don't think it's necessary, and there's no hard things to understand or hard things to grasp it to acquire some knowledge regarding this. So we can move on here. We can move on here. Rockets, turtles, pigs. So here we are at the last stage. Mutual funds and stocks are different. Why mutual funds here? Mutual funds is managed by professionals. Like we have said that mutual funds are managed by fund managers, professionals. They had very long enough experience, and like in case of educational qualifications, or they are reputed persons and popular persons and managed by professionals. Mutual funds and your money, your cash is invested in many companies, various companies, like diversifications, as we have mentioned. And regarding such that you directly buy shares of companies, like we have say Asian Paints, ONGC, Coal India, Larsen L&T, and Hindustan Zinc, and Gasoline. Lots. You can choose Reliance, Bharti Airtel, Wipro. So you can buy directly from that, or for this go to Zero Kite, and for mutual funds go to Zero Coin. So stocks, in case of stocks, that lower risk to diversification. In case of mutual funds, to lower risk to diversification. Okay, so let's try to understand this rockets. First of all, in case of rockets, the stocks or companies going very fast growing, okay, fast growing. So the main rockets here, like rockets, it's going fast and high revenue growth, high revenue growth and high profit growth, high profit growth, and often high P ratio, and higher risk, higher potential reward. That's we often say, and some trades that rapidly expanding technology companies and emerging market leaders, and from the point of investor view, and can grow well quickly, but can also fall sharply. Okay, in case of rockets. So let's go for turtles. Turtles is slow, slow and steady, slow and steady companies. Okay, turtles. And but the main characteristic here, turtles are stable, stable earnings, number one, and number two is consistent dividends, and third one, growth, moderate growth, and fourth one, lower volatility, lower volatility. And some trades, like for instance, consumer goods companies and utilities and established market leaders and all. So it's really, really understandable and graspable, and it's very simple explanation. I gave you simple explanation. And the last one, this is the last one for this time. We have is PICS. We call that PICS. This is the last one, and it's a nickname often used for companies or investors associated with excessive greed. Excessive greed. PICS. Okay, let me write here. PICS. Excessive greed. For companies like poor fundamentals and excessive debt, and second one, overhyped stories and unsustainable growth claims. For investors, for investors, for investors, number one is chasing unrealistic returns, false claims, taking excessive risks, unrealistic returns, okay, unrealistic returns and risks is too high, excessive, and refusing to take profits due to greed. Refusing to take profits due to greed. According to the investor view, greed often leads to losses. According to the investor point of view, greed often leads to losses. So there are comparison to, in case of rockets, growth is very high and risk is very high, and it's suitable for aggressive investors. And in case of turtles, growth is moderate and risk is low to medium and suitable for long-term investors. And in case of pigs, growth is uncertain and risk is very high and suitable for usually avoid. So pigs is no choice. Pigs is no choice. Okay. And turtles for long-term investors, and risk is low to medium and growth is moderate. And rockets, growth is very high and the risk too is very high, and for suitable for aggressive investors. So rockets can make you rich fast and turtles can make you rich steadily, but pigs often teach expensive and no hopes. I hope that you grasp knowledge and you grasp all that things, important things I told you. So research before buying stocks. Before buying a stock, you have to check that company business. You have to check that company business and revenue growth, profit growth, that level, management quality, future prospects. Never buy a stock simply because someone recommend you unless you've done uh, adequate research by yourself or you've already a consultant or you have sound knowledge regarding financial planning or investment or wealth building or wealth creation. So keep in mind that, right? All right, friends, investing is not a gambling. Investing is not a gambling, okay? Investing is not getting rich overnight. It's not overnight, it's consistent and it's long time, at least 10 to 15 years. And investing is a disciplined process of building wealth over time, smart discipline and consistency, and start small. Whether you start by rupees 100, 1K, 500, 2K, 5K, it doesn't matter. But consistencies matter and invest regularly, whether invest daily or monthly or quarterly or semi-annually or yearly. But you have to be very regular. Okay? Be patient. When the market slows down, don't just be sad. So be patient and stay diversified. Don't invest in a single stock or single mutual fund. So at least a whole or allocate that a portfolio at least 5 to 10 or maybe five, at least five. In case of stocks, 5 to 10 is enough, and in case of mutual funds, five, six enough. Okay, 5 or 6. So don't invest in only one stock or only one mutual fund. So keep learning. You can learn through YouTube channel, free of course, and you can learn through Coursera. You can learn through many things. You can learn through AI like GPT, or you can learn through many things. You can learn through books and all, and you can learn through my YouTube channel itself. So it's free of course. So you can learn. Keep learning, and learning is the best things that you can do, that you can learn, you can research yourself. And if you are not from that commerce background or if you don't have a sound knowledge, and do consult me and call me or WhatsApp me or mail me, or you can talk and you can discuss a lot. Okay, the best investment you can make is in your financial knowledge. Thank you for watching. So stay invest and regular and be patient and plan regular, and don't invest by recommending from unknown. Do research and do learn and do explore by yourself and consult, consult, register financial consultant or investment consultant or wealth management consultant like me. I've already told you. Okay? Thanks for this times and see you next time. Bye bye.